Hey, welcome back. With the stock now at the lowest levels in the past 5 years and the dividend getting above 6%, I think this might be a very good time to look into Realty Income. Before we get into that, we have to understand the current market environment. With interest rates at a 2-decade high, we have US Treasury notes paying a yield of more than 4.5%. Add everything else that's going on the planet right now, which is generating uncertainty, and you can see why there is not as much demand for companies like Realty Income. As a result of these things, money is being moved away from these bond-like investments that carry some degree of risk into, the real thing. To some degree, I guess it makes sense, why would you risk it with a company like Realty Income that's paying you 5-6% per year when you can get the risk-free 4.5%? But in a couple of years, when we see interest rates decrease and treasuries paying like 2%, then we suddenly have a much more compelling difference. In my opinion, this migration of capital can lead to some once-in-a-decade opportunities because companies like Realty Income have quite some potential in the long term, and I honestly don't see them staying at a 6% yield once treasuries pay less. Not only that, but then the company and their tenants will be able to borrow at much lower prices, which can help boost the growth, the financial stability, and maybe even the expansion in Europe. The business model is pretty much the same as with most of the REITs. You get debt at a rate of let's say 3-4% per year during good times and invest it in real estate for 9-12% or even more. You can then use the difference to pay back the debt and, in time, even some massive dividends. This allows them to compound and become bigger and bigger the more times they repeat this cycle. They have a diversified and high-quality portfolio of clients with companies like Walgreens, CVS, Walmart, FedEx, Tesco, and so on. As we can see, the rent comes from a wide number of industries and places, and a lot of these companies should be pretty resilient to economic changes. The occupancy rate is at around 99% right now and has always been well above the average of the other S&P 500 REITs, so that's another plus. Now, for a market cap of around 35 billion, they can produce around 2.5 billion in adjusted funds from operations after buying another REIT about 2 years ago. This puts them at a ratio of around 14, which is normally around a fair value but pretty low for a Realty Income. As we can see, the debt is well spread over the next more than 10 years and no year should represent a big threat for them, which is great for a REIT. They are also investing a lot in Europe since 2019. Currently, they are investing around $500 million per quarter into this market, but once we see interest rates at a lower level, I think we can expect this to ramp up again. We can see that the European portfolio is just as diversified as the American one, and we can expect it to expand over more industries and clients as they buy more properties. This one is definitely something to watch in the future, and you can see on the screen that there is a lot of potential. And now, to look a bit deeper into the dividend, we can see that this is one of the few companies out there that pays the dividend monthly. They currently pay a bit more than 25 cents per month, adding up to a yield of around 6% today. This represents a cost of around 2.16 billion per year, which means that after they pay this, they should have around 350 million left to do whatever they want. What's interesting about monthly dividends in general is that in the long term, they can lead to better profits. That's because it allows you to invest and compound the money just a bit faster compared to a stock that pays you every 3 months, for example. The difference is not really that high, but in the very long term, it can be pretty noticeable. Something I didn't address in my previous video is the fact that the number of shares keeps going up. There was a big spike in the number when they had the merger a couple of years ago, but that's a bit different since you also got a special dividend. We have to remember that as a REIT, they have to pay at least 90% of their taxable income as dividends, so if they need money to invest, which they do a lot, they don't have that many options. To be honest, I'd rather see them do this than issue some expensive bonds, sell real estate, or get a loan, especially at these interest rates. A recent example of a big investment they made is this casino resort in Las Vegas. I'm not a fan of it, but I'm sure they know what they are doing. And just a few days ago, they announced a new merger with another REIT, which is going to be funded by issuing shares. Obviously, diluting the number of shares is going to lower their value in the short term. I also want to address a few risks. Number 1, we could see interest rates staying at a high level for a longer time than expected. This will affect the stock and will lower the growth of the company for a few years, but the real long-term impact is probably meaningless. If anything, it would probably push the stock price lower, which would make it even more attractive. Number 2, a recession would also come with similar effects, but they have good financials and a pretty defensive portfolio of clients. To be honest, I'd rather see these two as opportunities for me to improve this position than risks, because the real impact on the company itself would probably be much smaller than the market's reaction on the stock. Another risk could be the shift towards e-commerce. This can affect them, but this kind of real estate will always have some usage. Maybe in 2 decades from now this is not going to be a pharmacy, but it can be a data center for a cloud company, for example. Anyway, I think we are many decades away from using Realty Income's real estate for something else than we currently do, and they are also expanding into other industries. As for a valuation, let's assume an average AFFO of 2.4 billion today to be a bit more conservative. In a bad scenario, if we maybe see a big shift towards e-commerce and a lower and lower demand for their real estate, let's assume a 3% average decrease per year. I have to mention that this real estate is probably going to keep being valuable and there is probably someone that's going to rent it anyway, but let's assume this just for the sake of the example. In 5 years, they'd get to an average AFFO of 2.06 billion. Assuming a fair value at a price to free cash flow ratio of around 15, that's a market cap of around 31 billion and a stock price of around 43.6. That would be around 15% less than today, although the dividend would actually make this profitable by that time. In other words, the current valuation is already pretty conservative and this price doesn't seem very fair for the company's actual potential. In a good scenario, with a growth rate of around 5% per year, they would reach 3.06 billion in the same period. 15 times that amount is a market cap of around 46 billion for a stock price of around 65, so around 30% more than today. Adding the dividends, we get to a profit of around 60% from the current price. For a ratio of 20, however, which is closer to this company's normal, that's a market cap of around 62.1 billion, meaning a stock price of roughly 86.4. That would be a profit of around 80 to 90% from the current price, plus another, let's say 30% from dividends. As I targeted in the previous video about them, now that Realty Income stock price has fallen to around 50 bucks and the dividend is above 6%, I bought this a few weeks ago. To finish, I would say that Realty Income is a high quality company with good financials, a very attractive dividend and a good potential to grow in the future. The expansion in Europe can unlock a lot of growth, the tenants are diverse and reliable, and I think that interest rates going down will benefit this company a lot. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.